longer dated treasuries, or suggesting it will revise down growth forecasts. Mark Rogers is a senior U.S. economist at Econoday and former economist for the Atlanta Fed. Our guest host, of course, is Sir Martin Sorrell. He is also joining us. And Mark, if I could start things off with you, I mean, does the Fed really have any room to run? What do you expect them to do today, if anything, perhaps wording changes in the statement?
I suspect that the Fed really had hoped for a quiet August, but obviously didn't get it. Traders clearly are going to be parsing today's statement far more than usual, looking for any subtle changes in the Fed's view of the economy. So I think one of the first places traders are going to look for some kind of encouragement from the Fed is whether there has been a positive change in the real economy. Obviously, if you've been watching the financial markets, the stocks are miserable shape. But if you look at the real data, the real economy data, I think the Fed will be able to point to some areas of improvement. Labor markets, actually, if you look at last week's numbers, they were on balance better than negative. We had everything from construction spending up, motor vehicle sales up, a dip in unemployment, in the jobless claims, a jump in chain store sales, and of course the better than expected payroll report. So even though we had some soft news from the ISM reports and personal income report, the Fed can point to, and this is what they do in the statement, point to the latest economic conditions. So I think it would be good for the Fed to come out as a clarifier. Yes, the financial markets are in turmoil, but the real economy, though not great, the latest numbers actually show marginal improvement. Then, of course, we need to look at what the policy statement is in terms of the directive. And the Fed has focused on.
Don't you think the Fed needs to do a little bit more? Don't you think the Fed needs to do a little bit more than say, hey, the latest jobs numbers were pretty good? I mean, look at everything else that's happened since then. That seems like a decade ago that we got those numbers.
It does feel that way, even though it was just last week. However, the Fed, their policy instruments currently are the Fed funds rate, basically zero. Can't really go any lower than that. And quantitative easing is an option. But let's look at the numbers, what the Fed has done. The Fed's balance sheet is just under $3 trillion. And when QE1 started, it was just over $1 trillion. So we've almost tripled the Fed's balance sheet. And in tandem, excess reserves have risen sharply. So the problem is not that the Fed is too tight or should loosen more. And even prior to QE2, there was debate within the Fed whether QE2 had benefits that offset the potential negatives, future inflation. Now, personally, I think there were benefits. But for the policy statement today, the Fed's options really are to be a clarifier about the economic news and to basically restate that there's liquidity in the markets, and there actually is probably going to be what I would call QE 2.1, because when QE 2 ended at the end of June, the Fed's balance sheet was basically a little under $3 trillion. But as soon as that program ended, there continued to be a natural unwinding on the pay down of mortgage-backed securities and agency debt. So when QE2 ended, technically, if the Fed did nothing, there would be a natural unwinding of its balance sheet. So if the Fed chooses to continue, which I almost certainly believe it will, to reinvest pay down, technically that's a new quantitative easing. You don't really want to call it QE3 because we're not expanding the balance sheet, but we're maintaining the balance sheet.
Very interesting thoughts. Thank you so much, Mark Rogers, for joining us, a senior U.S. economist at Econoday and former economist for the Atlanta Fed. Our guest host, Sir Martin Sorrell, is also with us, and he's sticking around.